Swayam Prabha. Digital India. Educated India.
Hello, in this session we are going to discuss about a concept of collective investment, that is called mutual funds. If we are an investor and if we are, let us say, rupees 1 lakh in cash, then we like to invest in as many securities instead of investing in one security, because if you invest in one security, in that case you will not be able to get the opportunities from different securities that is available. So, to take care of that particular problem, we will like to spread this amount of 1 lakh rupees among as many shares or bonds or debentures or as many finance instruments that we can have hands on. So, in that case what happens, our 1 lakh rupees gets divided among as many securities, and we will be having small number of shares of different companies or different entities. So, in that case more transactions will be taking place, because we like to buy one and sell one. In that case more transaction can take place. So, the transaction cost can be very high in such case. So, if it is not 1 lakh, if it is, let us say we have got 1 crore rupees of cash with us, in that case it becomes little easier for us to invest in as many securities. So, this particular problem of the desire of the investor to invest in as many securities is taken care by a concept called mutual fund. What happens in a mutual fund, so many people, like all the investors, different investors, they put money and those money gets collected and that are put in different securities. So, coming to that, the definition of the mutual fund. Mutual fund is a trust that pools the savings of a number of investors who share a common financial goal. So, in fact, the investor that they are investing in this particular scheme should have a common investment goal, like somebody like to have only the income or somebody like to have growth in the fund for that matter. So, same type of investors is with the same type of desire, they pull money, give it to someone and it gets managed, and somebody manages for them and they get the return or whatever at the end of the particular period. So, the money is collected typically from all the investors, and that they get invested in different capital market instruments, like it can be shares, it can be debentures, it can be other securities, it can be short term securities, it can be long term securities, it can be money market, it can be capital market, whatever the form of financial securities, they can be pulled and invested there. The income whatever the investor earns from these investments and the whatever change that has taken place in the capital appreciation form, they are realized and transferred to the investors at the end of the particular period. So, what happens in this case, the mutual fund becomes a very suitable investment for a common investors who do not have the access to the techniques, the managerial skills of managing different financial assets. So, he depends upon someone who manages the money on his behalf, and like him several other investors also can put money, and accordingly the money can be invested in different securities and the returns can be generated. So, typically what happens in this case, a diversification benefit is received by the investor by putting the money into mutual funds. Coming to the next one, if you look at this particular chart, in this chart we have the investors who give money and that go to somebody called a fund manager. So, they pull their money with the fund manager and this money goes to the different securities, it could be bonds, it could be shares, preferential, as many long term instruments, short term instruments, whatever. Then these securities in the form, they generate certain return in the form of dividend on the shares, interest on the bonds and debentures, and these returns are ultimately passed back to the investors. So, there is a flow of funds like this from investor, the fund manager, they go to market, and for the market you get a return, and like that it goes on. So, this is a typical mutual fund operation chart. Then why this particular mutual fund concept is important? Because mutual fund helps in channelizing the investments and helps in channelizing household savings from the household to the productive segment. So, what happens? It also helps in resource mobilization in the primary market. So, there mutual fund also gives a source where you can put the money and this money can go to corporates who can ultimately invest in productive assets. So, and in this way the small investors investment avenues also gets increased, and not only that, you in the mutual fund scheme we also have something called an entry and exit. So, it is not that you put the money in some instrument and then forget about it, or if you like to exit from that particular investment you cannot exit out of that. So, but mutual fund by its structure itself, by the market operation itself, it gives an entry option as well as exit options. That means, somebody can enter the mutual fund scheme after some point after it is issued earlier initially, and somebody can also exit from the scheme where he has already invested in. So, in that case the liquidity is always there as far as, so the liquidity of the market also gets enhanced with the available mutual fund scheme. Then it also in way by that, because the money gets invested in the corporate sector or government sector for that matter, ultimately this contributes to growth in the GDP of a particular country. Next, you look at who are the typical players in the mutual fund industry. One is that called asset management company. Asset management company is the company where whom you give the money, okay, and they only manage the money and they convert the money into certain securities and then manage that which particular share to be sold, which particular share to purchase during the particular period of time. All these things are taken by them. Then you have intermediaries, like you have got brokers, and these brokers, the transfer agents who will be because the investor cannot directly approach the mutual fund company as such. In that case, it is approached to the broker. Then there can be banker also, intermediaries there. Then there can be transfer agents where you can transfer your mutual fund schemes, who will be facilitating actually the transfer of mutual fund schemes from one investor to another investor. Then you also have obviously the investors at large who are investing in the mutual fund scheme. Then you have a major player called Securities Exchange Board of India, SEBI, in the government of India. As in the Indian setup, we have a SEBI, which is a regulator of the capital market, which also regulates the mutual fund operations. So, how the asset management company should act, how they are going to manage, what are the fees they can charge, what are the different rules the intermediaries should follow, all those things are regulated by the SEBI, so that investors have some trust in the market. Then going to that typical structure of mutual funds in India, we have 3-4 parties there. One is the sponsor, second one the asset management company, then you have board of trustees, then you have a custodian, then you have who take care of safe custody, trade settlement and transfer agents. So, sponsor is something who announces the scheme, like let us say State Bank of India in Indian context, it will announce a mutual fund company, asset management company. So, they are the sponsor of the AMC, and the AMC actually gets the money from the investors, pulls the money from the investor and invests there. Then there is also asset management company that we have. Then we also have something called board of trustees. The trustee is responsible to see that it is as mandated by SEBI as the regulator of the market. The trustee is responsible to see that the rules and regulations are followed in true spirit, and it is typically to protect the investors' interest. Then we have the custodian. Custodian will have the physical, if the security is in physical format, the custodian who are going to hold it, and custodian is also going to have the settlement to trade. That means, somebody will like to buy or sell, and that case they are going to facilitate this particular thing. Then custodian also work as transfer agents, from one party to another party the schemes get transferred. At the same time, the shares what is there in the mutual fund kitty or the instrument that is there in mutual fund kitty, if they are sold or they are purchased, those transfer also taken care by the custodian of the particular mutual fund scheme. So, if you look at the chart here, we have an unit holder on the top, then we have another someone called SEBI, this is another player. Then there is a AMC, so unit holder gives money to AMC, and AMC is actually sponsored by a particular company, and then the sponsor also has got certain trustees. So, trustee and AMC are there. Then there is a mutual fund scheme, then you have transfer agent, then you have custodian, and overall you have the SEBI to regulate the market. So, these are the typical organization mutual fund in any setup for that matter. Then what is that there in the mutual fund that one should, what is the attractive points as far as mutual fund schemes are concerned? One is that you have got something called a professional management. So, in this case, since the money gets accumulated, pooled, and the money is given to the particular mutual fund scheme. So, mutual fund scheme, because the size of the fund itself, it can have a professional management team who can apply different analytical skills, quantitative skills, and find out which particular investment to choose from among and which particular investment should be sold. All those professional requirements can be taken care, all the sophistication can be taken care by having a professional management. Since this scheme is the money pool is very huge, and in this case the mutual fund, the AMC can afford to have professional management team which can give the suggestions and advice for that, how to and manage the fund also, how to go about this, so that the investors at the end of the day gets the maximum rate of return possible. Then since the money is going to be very high, the pool is going to be very huge as such. So, in that case there is an ability of the investment management company, the AMC, to diversify into as many stocks, as many instruments, which is not possible as a single investor, because single investor have got a small amount of money which cannot be diversified into as many things. But in the case of mutual fund, even if one invests only rupees 5,000 in a particular scheme, he or she gets the benefit of as many shares or as many instruments the particular AMC has invested as far as that particular scheme is concerned, which is not possible for an individual investor to do that. So, the diversification benefit can be there from a small investor point of view, though he does not invest in different shares, but he still gets the diversification benefit of investing different shares. Then we also, it also becomes convenient to administer because of the large pool of money is involved. Then mutual fund schemes, because it is managed by professional people and there is a diversified pool. So, return potential is going to be much little better compared to managing on your own, because there could be a lot of risk involved, and which is taken care by the mutual fund scheme by way of diversification. Then since there is a huge amount of money is pooled as such, in that case the cost of managing fund proportionately becomes lesser compared to a small amount of fund which is managed by the particular person, because whatever the buyer selling transaction somebody does as an individual investor who builds his own portfolio, then this transaction cost like buying and selling of the shares that he or she has in portfolio can be much higher compared to the portfolio size in that case, proportionately, which could be reduced in case of a large pool of funds in case of mutual fund scheme. Then we also have the benefit of liquidity. Liquidity means the like any other instrument, this instrument or mutual fund schemes can also be sold or can be purchased from the market. So, maybe from the secondary market or maybe from the fund itself or AMC itself, the particular scheme can be purchased later or the scheme can be sold to them. So, there is liquidity. So, the investor need not get stuck with the particular investment, and there is an avenue that he or she, if he wants, can exit from the option whenever he or she feels like. Then there is also transparency, because this particular market is regulated by Securities and Exchange Board of India, SEBI. So, they ensure that the rules are regulations are followed, and at the same time what happens, there is a mechanism where the mutual fund AMCs are supposed to disclose the financial assets they have invested in as per the particular scheme is concerned periodically, possibly could be monthly or quarterly, or in their website itself they can disclose how this money has been put, so that the investor knows that where his money has been put. So, there is a transparency involved, and investor also can ask for certain information as per the law from the AMC that how this money has been put. So, this is also there. Then you have a flexibility in the terms of you can exit any time, you can enter any time, you can go for different schemes as such, and the AMC itself has the flexibility of putting money and n number of securities. Then this best thing that is there in case of mutual fund market is the choice of scheme. There are umpteen number of schemes where the investor can put looking at his objective. He will like to have a long term prospect, he will like to growth prospect, he will like to have regular income, he will like to have something like a pension, whatever that may be, all the types of schemes are there as far as mutual fund schemes. So, there is choice of schemes are there, depending on the investment objective of the particular investor, you can go for any scheme that is available in the market. Then certain mutual fund schemes also give some tax benefit. If one invests in that particular scheme, then investment is taken as a tax relief is also there as depending on the particular country's income tax policy. Then as we have discussed, there is a regulatory agency called SEBI, which regulates this market, and that is why the mutual fund is something like more regulated like any unorganized investment market. This is an organized investment market which is well regulated by the particular regulator in particular country, and in India it is the SEBI for that matter. Then, but there are certain problems also as far as mutual fund schemes are concerned. Mutual fund scheme will not guarantee that we will be giving this much return. So, there is no guarantee as such, but it has to be something based on historical performance of the company. Then you may say that okay, of the scheme as such, the investor can expect okay, this much return is possible from this particular scheme, but the mutual fund AMC is not going to give any guarantee for that matter. But at the same time, there should be fees and commissions are also involved. So, fees and commission means when you enter the market, when you purchase this particular scheme, you may have to pay a fee like entry fee, or when you exit you may pay a exit fee for that matter. So, those things are there. Commissions are also going to there as far as you deal through certain brokers or intermediaries, a commission can be there. In any case, the commission is going to be there also in case of investments made by the investor directly into stocks, shares and bonds for that matter. There also you are going to pay the commission to the broker. So, this is not a bigger limitation of mutual fund scheme, which is also there in any other investment where you have to deal through transfer agents or brokers for that matter. Then there can be taxes on the return from the mutual funds, that can be there. At the same time, the mutual fund scheme can be subject to the management risk of the AMC. So, how this AMC is managing the particular fund, that is going to take care of the risk as such. So, the management is not well versed in managing the fund, then investors bear the risk of that particular problem. Then certain management go for over diversification, they go for over dilution in that case. So, because excess diversification of different schemes is does not benefit the particular fund or particular investment for that matter. So, in because there is a lot of things available in the market, so they may go for over diversification, which may not actually yield a proper return for the scheme for that matter. Next, we move to certain terms in the mutual fund market. The terms are like this. We have got something called a net asset value. So, what is net asset value? As the schemes as we discussed earlier, the mutual fund scheme is going to get the money from the investors and put in different securities. So, the value of the securities is there, which is nothing but the total value of the assets, that is called the financial assets where the mutual fund scheme has put the money, and at the same time this particular scheme may have certain liabilities that may be due, maybe to the as a commission to be the to transferor, to the custodian or something like that, there could be some liabilities. So, this is the pool of assets and this is the liability of this particular scheme at a particular point of time. So, when you take the value of the assets and take out the liabilities that is due to be paid by the scheme and divided by number of units of the particular mutual fund, that gives you the NAV, that is net asset value per unit. That is a very common term which is used by the mutual fund as such, where you get new. So, that means, if the value of asset is let us say 53 crore rupees 53 crore and the liability at a particular point of his time is rupees 3 crore and divided by let us say there are 10 crore units of this particular mutual fund, then it becomes 50 by 10, that is rupees 5 per unit. So, NAV is rupees 5 per unit. So, what happens if somebody has invested in a fund where the NAV is at present rupees 5, he or she will like that rupees 5 to go up to certain value, but ultimately also can also come down. So, the change in the NAV from one point to another point is essentially a return on that particular scheme. So, if the NAV goes up from 5 to it becomes 6, then there is a 20% return on that particular mutual fund scheme. So, this is the way where NAV is calculated, and you can also compare the NAV of one scheme, the 1 year with one time period with another time period as such. Then we have something called repurchase price. What happens if the mutual fund, there is an option where the fund itself can repurchase, means purchase the scheme, purchase the unit from the investor, and during the period of time, that is whatever rate it purchases, that is called repurchase price. Similarly, when the life of the fund gets exhausted, that means redemption times come, let us say it is a 5-year scheme for that matter, at the end of 5th year, if this fund is will be giving the cash and takes back the units, that is called redemption price of the particular scheme. Then when the purchase or sales takes place, so when you enter the market, enter the mutual fund scheme, so in that case when the mutual fund scheme scales a scheme to the investor, and that time the investors may be required to pay a load, that is a entry fee as such, so that is also known as front end load. And similarly, when the mutual fund investors exit from particular scheme, in that case the mutual fund company is going to give the cash and they are going to take back the units as such. In that case, the mutual fund agency may ask for a certain load, that is called the entry load as such. So, repurchase can be there, the sales load can be there, is a front end load, there is a repurchase can be there, the back end load can be there. Then coming to the next thing that we have, that is called types of mutual fund schemes. The mutual fund schemes can be classified in different ways, that is, one is by structure, then one is next is by investment objective, next is by the other classification could be there. When we say structure, we mean that there could be something like open ended fund and there is a closed ended fund. Open ended fund, what happens here, any time you can issue the mutual fund company, the AMC can invest, can issue new units, can also sell the units at any point of time during the particular period as such, and there is no redemption period that is given as such. That means, when the investor buys the particular units, he or she can sell it to the mutual fund back that whenever he wants. Similarly, if somebody has not invested earlier, will like, or even if he invested earlier, will like to go for more units to purchase, he or she can also enter the market through that. You can buy the units again from the mutual fund company or the AMC for that matter. So, that is called open ended. There is, you can enter anytime, you can exit anytime that you feel. So, there are certain examples like FT India Balance Fund, which is a dividend plan, ICICI Pru Balance Fund plan is there, which is also an example of open ended fund. Then in closed ended fund, what happens, the mutual fund agency issues the schemes, issues the units, and there is no further issue of the units at subsequent point of time. So, in this case, the mutual fund, if you like to exit from that, in that case there is a market where you can sell your units or you can buy the units from the secondary market. So, once it is issued, it is closed, and at a particular point of time, maybe 5 years, maybe 6 years, maybe 2 years, 3 years for that matter, at the end of the particular time period, the mutual fund is going to give back the money and get the units back. So, this money what the mutual fund gives, or when you in an open ended fund, when you enter the fund or when you exit from the fund, that will essentially relate to the concept that we discussed earlier called the net asset value. So, if the net asset value has gone up, obviously in that case you are going to get more from the mutual fund company. If it has come down, you are going to get less. So, this NAV per unit is going to dictate how much you are going to get back from the mutual fund, subject to any entry load or any exit load that is there for the particular scheme or not. So, there are certain examples, as we have Kotak blended fund, fund of fund, the Religare mid cap fund, all the mutual fund companies that we have in India or any country will have certain open ended fund or certain closed ended fund there. Then another way of classification of mutual fund is the growth or income. So, what happens in growth fund, you will always invest in a scheme and you will not like to have any immediate any regular return from the investment as such. So, you like to have that particular mutual fund appreciate over a period of time. So, you like to participate in the growth of that. So, in this case no intermediate income. So, there is no regular income that is there for the investor. So, whatever income is there at the end of the, when you either exit or maybe the redemption takes place, then you get the NAV back. So, in terms of NAV the money comes back. So, in that is the return that is going to be there for the mutual fund. So, what happens in this type of fund, typically they invest in equity type of instruments, because equity is something which gives the growth. So, they will be typically investing in stocks or shares. Coming to the next one that we have is called income fund. Income fund means the investors expect certain regular amount of income periodically. So, there could be somebody who will be like a pensioner for that matter. So, in a pensioner may be requiring a regular return of amount, because he will need that particular money for his bread and butter. So, in that case he will not like to invest in a growth fund, where growth fund means it is like since the money is getting invested in equity shares. So, there is a fluctuation, huge fluctuation in equity share value. In that case the value of the mutual fund scheme also can go up or come down depending on the shares they have been invested. So, the pensioner will not like to bear that particular risk, he will rather like to have a regular source of income from the mutual fund. So, he can go for something like income fund. Income fund means there is going to be a regular amount of return over a period of time. So, no is a periodic return, unlike in unlike in a growth fund which is not there, the regular return is not there, whereas income fund there is a regular return. So, what happens in this income fund, they are typical invest in fixed income securities, and so that what happens, you have a regular and steady income to investors. Then in this case also the capital appreciation is going to be limited, because these type of instruments are not going to grow like any equity share for that matter, but is suitable for retired people. Like we discussed, all the mutual fund schemes will have certain schemes that is like income fund. Then we have a mix of these two things. Some people will like to have some growth, at the same time they will like to have something like a regular income. So, mix of the hybrid scheme is called a balanced fund. So, in this case you have both income as well as a capital appreciation. So, for example, you have DSP Merrill Lynch as a balanced growth, as well as there is a HDFC balanced growth fund. Then we have got certain other schemes like specialized fund. That is the beauty of mutual fund companies. If they like to put money only in a particular type of securities or a particular sector securities, that can be there, but there may be some investors who like to invest only in power sector companies. They will like to have a portfolio like that. So, in that case, instead of they investing like that, there will be mutual fund company who will be investing all the money only in the power sector company. So, they can float a fund called or scheme called power sector fund, or they like to float a fund like IT sector fund or pharma sector fund or mid cap fund or small cap fund for that matter. So, they can be there. So, the sectoral fund or specific type of funds can be there by the mutual fund. So, the sectoral fund can be there. Then another scheme could be that you have got a money market scheme. Money market scheme means the investment that is made by the investment, that is the mutual fund agency, is only in the money market, it is short term securities. Short term securities means like your commercial paper, then you have got the treasury bill. So, here you have got this money put. So, you have got a short term securities, that is called money market. Then another fund can be like gilt fund. Gilt fund means the mutual fund company, the AMC, invest all the resources in government securities. Gilt stands for the government and quasi government securities. So, there they put. There can be a specific fund like offshore fund. Offshore fund means all the investments are made in companies which are outside the particular country. Then you have this another special fund like arbitrage funds. What happens if there are two exchanges and that one particular share is listed in that in a particular both the exchanges, both the market. So, there may be a difference in the price as well. So, you like to have the arbitrage of the difference in the price. So, there will be certain mutual fund schemes who will be cashing on the arbitrage opportunity that is existing in the market and getting the best benefit available for the investors. So, like the SBI arbitrage opportunity fund is one of the example. Some other specialized fund, that example that talked about sectoral fund example is called Prudential ICICI Technology Fund. In money market we have a Reliance liquid plan, Bank of Baroda mutual fund, they have a liquid fund, UTI money market fund is also there. In a gilt fund, that is government securities, then you have a real estate fund also, where the it is like a sectoral fund where the money gets invested in the real estate companies. Then one has offshore fund like a Magnum fund is offshore fund. Then we also have some scheme like tax savings fund. So, in this case what happens, investment made in this particular fund is eligible for tax relief. So, you have got GIC tax saver, UTI master equity plan, HDFC tax saver, like as many schemes are there where you can have it, the investor can have some tax relief. So, if you look at plot this particular types of funds in a risk return profile. So, the liquid funds are supposed to be the least risk, because the liquid funds means you have got a very high liquid there, means you are going to put in short term securities, and short term securities, short term government securities, short term commercial papers for that matter. So, their return is going to be much lower, at the same the risk is also going to be lower. Then we have got the next one is called debt funds, where the money gets invested into long term bonds, where the some income is also little higher income is there compared to the liquid funds. Then one can go to something like balance fund, where the person who has invested, the investment company invests in a equity as well as debt instruments, that is called the balance fund. Then we have called equity fund, but before that we have something called index funds. In the index fund, what happens, instead of the company, the mutual fund company investing in different shares or bonds or financial assets on their own, they actually replicate a particular index, like we have CNX Nifty or BSE Sensex. So, they only put the money only in those 30 schemes of BSE Sensex, or the 30 shares of the BSE Sensex, or the 50 shares of the Nifty for that matter. So, they are actually replicating the index. So, diversification is taken care by the index by investing in different types of shares, that is part of index. Then we have got, so index funds in the diversification is already there by the index itself. So, it is going to little less riskier than an equity fund which is entirely constructed by the mutual fund company. And in equity fund, the mutual fund scheme is, the AMC is free to subject to whatever they have declared in the initial fund offering, and they can put into any sector for that matter. Whereas, next one that you have the highest risk, but you can also possibly give the highest return is sectoral funds, where let us say we say talk about like technology sector fund or pharma sector fund or R&D fund for that matter, or power sector fund. So, there is sectoral fund is the highest risk and the highest return potential that we have. Now, we move on to other categorization of the mutual fund. It is, as we discussed earlier, certain people will like to have certain regular income. So, in that case we have got certain schemes, like for example, Kothari Pioneer, they have got a Kothari Pioneer pension plan fund. So, what happens in this case, as a regular return something is going to be there for the investor. So, it is like it is targeted for investor like a pensioners as a retired citizens for that matter. Then the mutual funds also can be classified into base of load. Load means, as we discussed earlier, when we buy the schemes from the company, buy the units from the particular AMC, then in that case the AMC may charge something like entry load. Similarly, when you sell the schemes back, sell the units back to the AMC or the mutual fund, then the company may ask something for exit load. But there may be certain companies AMCs which will not have any load, or they may have only entry load, they may have only exit load, or they may not have any load. So, based on that the investments can be, the mutual funds also can be classified. So, that means load fund can be there, and there can be also no load fund, where there is no marketing cost is actually charged by the AMC to the investor for the, whether it is entry load or it is an exit load. Then another way of classifying the mutual fund is style, management style. So, one way as we discussed in previous slides, the mutual fund company has the option to invest on its own in different schemes. So, the mutual fund can say that okay, we are floating a growth fund. In that case, it is attractive option for the investor, the investors subscribe to this particular fund. Then it is a growth fund means obviously the mutual fund company or AMC is going to invest in the equity shares of the different companies. So, depending on their managerial skill and their whatever the style that they are functioning with, and they can choose any share in the particular market. So, there is no restriction for them. So, that is called active management. They will be, and they will be churning the portfolio as frequently as possible. They will not depend on anything. So, they feel that somebody is undervalued, then they will buy, and if somebody is overvalued, if they are holding that particular instrument, they are going to sell. So, there is a very active portfolio management. Another thing is a passive portfolio management. The passive portfolio management or passive investment strategy, what happens? They do not, in that case, they have a strategy of holding a portfolio of securities without attempting to outperform other investors through superior market forecasting. In a active investment strategy, they will always like to outperform the market. So, they may have a benchmark inherent that we will always like to give the more return than what the market can give in terms of index, let us say Sensex or Nifty for that matter. So, in that case, you have an active, they will always like to outsmart the market, whereas in passive one, they may like to replicate the market as such, the index as such. So, types of passive portfolio can be index funds, or we have got a customized funds, or we have got a factor or style funds for that matter. Index funds means we have got, if you go to the subsequent slide, we have there index fund. What happens? You will have a portfolio which will replicate the particular benchmark index, would could be S&P 500, would could be BSE Sensex for that matter, and whatever there is, but there can be return difference also, because in the meantime the certain company in the particular index that is comprised, they might have been merged or they might have been sold off, hyped off for that matter. So, if that particular change has taken place, so it may not be possible directly replicate that. So, there could be possibility that you may get little lesser return than the what the index is actually giving, but it is likely to replicate that whatever the index is going to give. Then next thing that you have got a customized fund. In that case, in index fund, what happens? We used to, if there is a BSE 30 Sensex based index fund, the mutual fund company is going to invest in all the 30 scripts, whereas in a customized fund, out of 30 some of the shares will be chosen, and so there is a managerial skill and ability that is gets reflected here, and instead of investing all 30 scripts, they will be investing some out of these 30, but not going beyond these 30 scripts. That is called a customized fund, and so that you can have an adequate diversification, because there is an index comprised of 50 or 60 shares. So, if you put in money in 50 60 shares, the diversification benefit, because of over diversification the benefit may not be there. So, to control that particular point, they will be investing in among the securities in this 50 or 60 shares of that particular index, but not all, but maybe 20 or 30 for that matter. Then we have got a style fund. In that case, what happens? This type fund actually replicates a benchmark, and it will like to have mimic the particular sector. It could be a growth sector, it could be a small capitalist sector, and it could be high yield fund for that matter. Okay. And this particular also can be specialized or titled towards a specific sector or industry. So, sectoral fund can be also taken as something like a style fund, or in a sectoral index is there. So, in investment, the mutual fund can invest in a particular sectoral index based company. So, this looks like a style fund, means a particular style is being followed. One scheme can be there, something called a small cap. So, they will be identifying only small cap, small market capitalization based companies, they will be investing in that, because the fund manager may feel that this particular scheme is going to, this particular shares in small market capitalization companies, they are going to give more return, they might have more return potential, they will always go for that. Somebody may, some other fund managers may feel that no, mid cap, which is neither large neither small, they can give more. So, they can invest only in mid cap or mid cap companies, or some other fund managers may feel that they can only invest in large market capitalization, large cap shares. That is also another type of style fund that is available with all the types of mutual funds companies or AMC that we have in our country or any country for that matter. Then we have got other classification of mutual fund, is something called contra fund. In a contra fund, what happens is very simple, that the fund manager does not go how the market moves, it does not go along with that. And what the typically different people, largely what the investors feel or the market feels, they will be feeling something other way around. So, market may not be recognize a particular share which has got a lot of growth potential, that the fund manager may feel, market does not recognize that. So, which is not bought or sold actively, but this fund manager feels that this particular stock has a very high growth potential. So, and similarly, so in that case the fund manager is going to put money in that particular type of scheme. So, he will be searching the market, scanning the market and looking for such particular investment opportunity like shares or other investment opportunities where the market is not paying any attention to such things, whereas this fund manager searches for that and looks for such things and puts money there. So, they are typically behaving contrary to the market what behaves. So, they may be also another case they may feeling that market may say that it is going to be downward, that means market may say that is the performance is going to be lower for this particular share, but they may still go for it because they feel that particular share may actually move upward. So, they are typically contrary in style to the general market condition. So, like you have a scheme like JAM has a scheme called JAM Contra, then Tata Mutual Fund has got Tata Contra, UTI has a UTI Contra, ING has got ING Contra. Okay. So, these are the things that is there examples of contra fund. Then we have got another very beautiful concept that has come is called it is called quant funds. These funds are based on something called quantitative analysis simulations. Here there is no question of sectoral allocation, there is no question of style fund or something like that. What they do here, they have a typical mathematical program, and in that they find out, they put that where they can get the best out of best return. So, there is a called a, and using the quantitative analysis simulation, they will like to have a particular number of shares. They may ultimately find that instead of putting money into 30 different shares or 50 different shares, they may find that if they are investing only in 5, because they found it with the help of simulation and quantitative analysis or something like, they can have optimization program inbuilt, which will tell that if the fund manager invest only such A, B, C, D, E 5 different shares, then return can be the maximum and the risk can also be the lowest. So, the decision is based on a sophisticated mathematical programming or a statistical programming or a simulation for that matter, instead of basing it on the fundamentals of the company or technical things that is of the company or the share for that matter. So, you have got Religare Agile fund, then we have got Reliance Quant fund. In Reliance fund, the Quant fund, we have got that they are only, though the Nifty, they is taken from Nifty, but they take only 20 stocks, that is from the Nifty, which has got 50 as such. That means, these 20 stocks they are putting today, it can change from day to day, because the optimization program or the simulation that they have done may say that you can drop one of these 20 and go for another out of these 30 left from the index. So, they will not be fixed that only these 20, rather depending on the return statistics of the different shares, they can also choose, they can change from one to another. So, it is not that 20 schemes, 20 shares where they have put the money is going to be fixed, it can change from a point time to time, but they will be always keeping all the things between the 50 of Nifty as. So, that is the, in fact, that will be specified in the objective of the mutual fund. When the mutual fund goes with this, the AMC comes with that particular offering, that they have to specify how are they going to put the money, are they going to put in a particular sector, are they going to put money as per this quadratic programming or quantitative programming, are they going to put money as per index, they are going to index fund for that matter, if this index, and then which index they are going to have benchmark or replicate for that matter, all those things have to be specified. If in case also they can also specify the growth scheme or income scheme or a balance scheme, those have to be specified when the mutual fund comes with a particular offer, initial fund offering takes place, all these things have to be disclosed by the mutual fund company. Then you have in this case, but for some reason the distributors do not advise retail investors for the quant funds, because there could be a lot of complications involved in that. So, they may not advise. Typically, we find that the retail investors are not advised to put money, but large investors can have the risk of investing in these particular schemes like quant funds. Then coming to the mutual fund investment, if you are a mutual fund investor, what is that you are going to look for when you invest or when you like to choose a particular scheme. So, in that case you have to look at whether this particular mutual fund scheme is meeting your investment objective or not. So, if you like to have, let us say, somebody who is in the age of 35-40 and who has a child who will graduate at the let us say after another 10 years, at that time some money can be required. So, accordingly in that case you can go for something like growth scheme, where you will get that money at the end of 10th year and you get something. So, if you have a scheme which meets this object, that you like to get some amount at the end of 10th year and you do not want to get anything periodically in between, then you can accordingly choose. So, you have to find out whether this particular scheme that you are investing is meeting your objective or not. Or you may be a pensioner who, or somebody who will like to have a regular amount of income. In that case he can go for something like a pension type scheme. So, you have to see whether this particular mutual fund where you are investing is meeting your investment objective or not. So, if it meets the objective, then you choose as many schemes, then you again find out whether which scheme we are going to go for. Then you have to also see if there is a transaction cost, if there is a entry load or exit load. Obviously, if everything else is constant, then we will not like to go for that scheme where there is an entry load or exit load. So, that is another thing which one may look at. Then one may also look at how diversified is this particular fund, because at the end of the day when we are putting money into mutual fund, we are taking the advantage of diversification which we cannot do on our own. So, if the fund is not going to be well diversified, there is no benefit of going for that, because the risk is not going to be controlled in that, because diversification leads to reduction in the total risk or portfolio risk for that matter. Then one can also look at something like initial investment. Some funds may have a restriction that you have to put some 1 lakh rupees initially or 50,000 rupees initially. Obviously, in that case if you do not cannot afford that much amount, so those schemes are rolled out for us, and in that case you will look at which particular scheme is asking for the amount which you can afford to invest at in the initial stage. So, that can be also another consideration to look at whether you will go for a particular scheme or not. Then obviously, we will like the credibility. Fund which is started just now will obviously have the credibility problem, because they are yet to prove in the market, or there may be as many AMCs available, then as many schemes are also available. All AMCs may not be doing well equally as such. Some of them may be doing well, some of them may be very bad also. So, there are third party agencies which publishes reports about the performance of the mutual fund. Then now also rating also possible as far as mutual fund schemes are concerned. So, one can look at also credibility of the particular mutual fund. In fact, one can also look at the credibility of the fund manager. When the mutual fund schemes are advertised, the fund manager's name and the team is also announced. There are certain instances where certain high net worth individuals invest only in those funds which are managed by a particular person. So, they do not go for any style, any sector, any index based fund, any company based fund. They rather go for that fund where the AMC is the fund manager is Mr. X or Mr. Y. So, they will go only for that, because they feel that whatever fund has been managed by Mr. X has done always better in the market, or they might have outperformed the market in a long term as such. They may go for that. So, the credibility also can be there depending upon the manager who is managing the particular fund. One can easily find out from the company's AMC's website and the other literature that is there given by the AMCs about different schemes, who are the fund manager of this particular, who are the managers of the particular scheme for that matter. So, these are the 5 different things where one can look at while investing in the mutual fund. Then one thing is what the mutual fund investment does, that AMC can do, one has to be careful about that, is that the mutual fund investor, the AMC may not have any strategy as such. Okay. Then other thing is the investor himself does not have a strategy where to put money. So, then you can also end up putting money in very high risk and non diversified fund, okay, because you may be swayed by the market, and some people may go by hot sentiment. They may say that this particular scheme is doing very well, so you can as well go for that. So, you may put more money in the high risk and non diversified fund. Similarly, one can also, because there are several funds, there are several schemes available in the market, you may go for same type of fund, maybe same power sector fund of HDFC mutual fund, at the same time the same power sector fund of, let us say, ICICI Pru mutual fund. So, in fact, what is happening, you are replicating the same thing and you are having duplication of the fund category. So, you instead of that one can go for a power sector fund, one can have a tech sector fund, but not 2 different power sector funds of 2 different AMCs for that matter. So, this duplication can be there, which should be avoided as a mutual fund investing strategy. Then how do we look at the mutual fund performance? So, there are as usual we have the returns and risk calculation also in case of mutual fund. So, the first thing that we have in mutual fund performance evaluation, the total return. As far as total return is concerned, what happens in this case? Any mutual fund scheme can have a periodic return which may not be a compulsory, may not be a guaranteed one, but can always be there. Then another that we have got the value that is happening into the NAV. The NAV is going to change upwards or downwards. So, if one has put in a mutual fund scheme at a particular point of time where the NAV was let us say rupees 18 and that is in a particular time period, and this NAV has gone up at the end of 1 year, that is it has become rupees 21, and during this particular period the in mutual fund scheme might have given a dividend of 2 rupees. So, in that case the return that the mutual fund has offered is dividend of 2 rupees plus the change in NAV. So, that and divided by the NAV that is in the beginning of the period. So, that means 2 plus 21 minus 18 divided by initial investment 18. So, that is 5 by 18. This is the rate of return that has come from investing in this particular scheme. So, you can find the percentage and find how much percent return. So, this is the way return on a mutual fund scheme is calculated. So, depending on different schemes you may have different returns, and you can compare and say which particular mutual fund scheme has offered more return or less return. Then another thing that we have of the performance is the expense ratio. What happens in that case? Do you have something called ratio of total recurring expense to average net assets? Average net assets is that is the opening net assets. Net assets means the assets minus the liabilities as per a particular scheme is concerned, and we have opening, we have got a closing. So, average of both these things gives gives average net assets, and how much expense actually incurred by this particular mutual fund scheme, because at the end of the day whatever expense is related to the particular mutual fund scheme, that is borne by the mutual fund scheme itself. So, if there is a fund management fee, there is a transaction fee, if there is a issue fee related expense, all these expenses are taken care from the fund available with the mutual fund company for that particular scheme. So, higher the expense to the asset value, the net asset value for the total scheme is going to be problematic for us. So, typically what happens, small funds will have this ratio to be higher, whereas large funds, because of economies of scale and economies of scope, they will have this ratio to be lower. So, similarly stock based funds or equity based funds are going to have a larger expense ratio. Offshore funds, or because there is a transaction cost involved in transfer of funds from one country to another country, buying there and investing there in the other country, forex translation cost can be there. So, those funds are also like to have higher expense ratio. So, one has to look at a particular scheme where this particular ratio is actually lower. Then one can also look at how much of buying and selling is done by the management as far as this particular scheme is concerned. So, it should be adequate purchase and sell. It should not be that only they have buying only very less amount of securities and holding on to long products. They should have a churning, but churning should not be as frequently as possible. So, that is also another thing we have to look at. Then one can also go for something like size of the fund. Size of the fund is a typically the bigger is the size of the fund, because economies of scope and scale, the return is going to be more, because the expense itself is going to be, expense ratio is likely to be lower in such cases. Then we can look at how is the cash flow in terms of dividend that is coming here. Then one can also look at how this particular fund has been managed compared to a benchmark. So, one can compare the performance of this particular mutual fund scheme with a benchmark like an index. If the index has been doing well compared to this particular mutual fund scheme over a long period of time, that means the mutual fund scheme has not done very well as such for the investor, right. So, in that case one can look at with the compare the benchmark and find out which is better, which is not the best one for that matter. Then we also have certain other things that facilitates investment decision making. We have mutual fund rating, that is in India it is possible. We have got a credit rating agency like KR, which has got a fund rating quality option now. So, they do something called credit scoring. So, they do that based on the historical data and how, what are the securities this particular investment scheme has put in, what are the investment they have put. Looking at that, they are giving a rating quality. They also look at something like a management, who are the manager, who are the AMC, who are the sponsor, what is the credential of the sponsor, all these things they consider and find out what is the management quality. Then what is the typical accounting system, MIS system that they are in vogue in this particular scheme or not. So, all those things they do, and what is the type of monitoring mechanism, surveillance mechanism they do. They also typically periodically withdraw this particular rating, and they give a symbol like KR AAA, KR BBB. This is the typical KR CF. F stands for the fund which relates to mutual fund rating. Then one also has something like a mutual fund rating in India, also a CRISIL, which does something like credit quality ratings for bond funds, where which particular bonds investment they have actually put the money. Then also have the capital protection oriented funds, they also have something like fund governance and process quality rating. So, they rate this a fund house, the AMC is being rated instead of being the scheme being rated. So, these are the things that we have discussed in a mutual fund. We discussed about the what is the concept of mutual fund. We discussed about different types of mutual fund. We talked about why should the investor put the money in mutual fund. We talked about different style funds, different index fund, different types of schemes available as a portfolio of options available for the investor. We also talked about what are different terms that is associated with a mutual fund, NAV, purchase price, exit load, entry load. We also now talked about the ratings that is available now in Indian context, like ratings by say KR or rating by CRISIL, which are the premier credit rating agencies of this country. Thank you.